Welcome to part 2 of our inventory reading. Okay, so we now turn our attention to describing the measurement of inventory. Earlier we talked about the cost flow techniques, FIFO, LIFO and average cost. We now turn our attention to the rules of the lower of cost and net realizable value that we find under IFRS and the lower of cost and market value that we find under US GAAP. Okay, so the rules, let's turn to IFRS first. IFRS says your inventory must be at the lower of cost or net realizable value. Now, cost, if you're a manufacturing company, of course, will be the standard cost of producing your goods and services, the standard cost of getting them into their current location and finished status. Any additional costs, of course, we're not allowed to include. So earlier we said any abnormal amounts, any storage costs for finished goods, any admin overheads, any selling costs cannot be included. It's only the cost of manufacturing and getting your finished goods into their current location. Okay, so it's standard cost, remember, rather than actual cost. Standard cost. Now, again, if you're a trading company just buying in goods and selling them, then of course our cost is going to be calculated using either the FIFO, the LIFO, or the average cost, or even, of course, specific ID methods. Now, once we've got our costs, we then need to compare that to net realizable value. What is net realizable value? What we do is we take the estimated selling price, how much we think we can sell the goods for in the future, minus the estimated cost of completion. Now, you might not see that line. That's only really going to kick in with work in progress. Work in progress, if you remember, is where we've started to produce goods and services, but not yet completed them at the year. Remember, when we look at inventory, there are 3 types: raw materials and components, essentially work in progress, and finished goods. Work in progress, simply where we've started to produce a good or service, or produce a good really, and not yet completed at year end. So if you have got work in progress, then you need to essentially include the estimated costs to complete the good, in other words, to get it into finished goods status. If you're looking at finished goods, of course, this line will simply disappear. Okay, so we take the estimated selling price, deduct any estimated cost of completion, then finally deduct any selling costs, any costs we think we might incur in order to sell those items. And that gives us net realizable value. Now, providing net realizable value is above cost, no issues at all. The inventory simply sits there at cost in your balance sheet. However, if net realizable value has fallen below cost, then we have a write down. And essentially what you do is you write down the value of the inventory in the balance sheet to net realizable value. The other side appears as an unusual or infrequent item in the income statement. What about if net realizable value then recovers and goes above cost in subsequent periods? Now notice IFRS allows you to reverse that write down. So you might record a write down this year, but then believe net realizable value recovers in the future and reverse that in the future. Now let's turn our attention to US GAAP. Lower of cost and market value is the rule. Okay, so notice we're replacing net realizable value with market value. Cost exactly the same as IFRS, the standard cost of producing your goods. But what is market value? Now essentially it's replacement cost, the cost of replacing those goods, but it's subject to an upper and a lower limit. Now the upper limit is net realizable value, and the lower limit is net realizable value minus normal profit margin. So as long as replacement cost is within the upper and the lower limit, we're going to compare cost to replacement cost. If replacement cost goes above the upper limit, then we're simply going to use net realizable value. And if it goes below the lower limit, then we're going to use net realizable value minus normal profit margin. Does mean it's a little bit more fiddly under US GAAP. Now notice as well, here's a difference with IFRS, and it's always worth focusing on where the differences between IFRS and US GAAP lie, because they make very common exam questions. Now here it says no reversal of write-downs. In other words, if you write down your inventory because market value has fallen below cost, fine, you have to write it down. But then if market value recovers and goes above cost, you cannot reverse that write-down under US GAAP. Now notice, IFRS did allow you to reverse that write-down. Now again, we often find this split between US GAAP and IFRS. Often what we'll find is US GAAP doesn't allow you to reverse write-down in impairments, whereas IFRS does. Now that's not always the rule. In particular, we'll see it differs when we look at goodwill impairments, etc. But it's largely the rule because, remember, IFRS largely is a more principles-based approach, and therefore it takes the view that economic substance should be reported whenever possible. In other words, if the economic substance is that your inventory is recovered, we should allow companies to reflect that change, reflect that recovery, and reverse any write-downs. US GAAP, slightly more rules-based and is more worried about this being abused. Essentially, we could abuse this ability to reverse write-downs by making a write-down this year and then reversing it next year to shift a load of profit from the current period into a future period. US GAAP a little bit more wary, so typically doesn't allow you to reverse write-downs and impairments once they've been made. Inventory valuation above cost, I wouldn't lose a lot of sleep about it. Just be aware that some markets allow this, and essentially, largely, it is if you are linked to commodities. So if you're producing a commodity, either a producer or typically a dealer of commodity-like products. Now, it's very much like trading securities, trading investments that we saw earlier. What you're going to do is you're going to report not at cost in your balance sheet, but instead at net realizable value. Now, of course, as net realizable value fluctuates, it means your inventory in the balance sheet is going to fluctuate over time. Where do the unrealized gains and losses get taken to? Well, notice unrealized gains and losses, unrealized gains and losses. And remember this phrase, unrealized, just means because we haven't sold the item yet, we still hold it. So the unrealized gains and losses are going to be taken through to the income statement. Okay, so very, very, very similar to trading securities that we talked about earlier. Our next learning outcome asks us to essentially describe the impact on financial statements and describe the disclosure of inventory. Okay, so look, we need to be aware of the information on cost of goods sales, the valuation method, and this of course is very important. The valuation method used to value the inventory, the FIFO, the LIFO, the average cost, the cost flow method used, and the accounting policies used. Carrying value, of course, needs to be disclosed of total inventory and then by appropriate classification. In other words, we're going to take the carrying value, and remember, whenever you see the phrase carrying value, it simply means balance sheet value. So we're going to see the total balance sheet value of inventory, and then in the footnotes, we're going to see the disclosure, the split, if you like, between raw materials, work in progress, and finished goods. So that's certainly going to be given in the footnote disclosure. Okay, we're still describing our financial statement information. So carrying value of any inventory reported at fair value less selling cost. When is inventory reported at fair value less selling cost? Well, typically when there's been a write-down. So notice, therefore, if there has been a write-down of inventory, we need to disclose the amount, essentially, of inventory that's been written down. Okay, so up here. So the remaining value of any written down inventory, and also we need to report the write-down itself. So notice the write-down gets reported. Remember, that's going to affect your income statement as an expense and any reversals of write-downs. Well, of course, you might see those under IFRS, but we're certainly not going to see them under US GAAP. Carrying value of any inventory pledged as collateral needs to be disclosed. So this is if we've used our ending inventory as security, if you like, for any debt that we've issued. So the idea here is maybe you've got a bond. If you were to default on that bond, your inventory would then lock up, i.e. it couldn't be sold at that point. It would lose any transferability, so you wouldn't be able to sell it. And therefore the bondholder could sell it off and use it to recover some of their outstanding principal. So if you have used your inventory as collateral on any debt that you've issued, again, that's going to need to be disclosed in the footnotes. Now, our LOS now is turning to explain the issues that the analyst should consider in inventory analysis. Okay, so we've got a few little conditions here. First of all, you look at this set of accounts and you can see that raw materials and work in progress have both increased. How do we interpret that? Well, hopefully, it's an indication that the company is increasing its raw materials because it's going to think that it's going to produce more. And why do you produce more? Well, hopefully sales will be higher in the future. So it could be an indication of an expected increase in demand. Okay, finished goods increase, but we're not seeing an increase in raw materials or work in progress. Again, this could be seen as a negative signal. If your finished goods have increased, but you're not actually producing more, and hence your raw materials and work in progress haven't increased, it could be an indication that your finished goods have increased simply because you can't sell them, i.e., therefore you've got a potential decrease in demand. Could be a big flag, therefore, for potential write-downs required as well. Finished goods growing faster than sales. Well, again, if the finished goods are growing faster than sales, again, it could be an indication of a decrease in demand. It could be, again, an indication that there are write-downs required and they haven't yet been recorded. Okay, so turning our attention to ratios, and again, look, our LOS is asking us to calculate and compare ratios. So turn our attention to profitability first of all. We're turning our attention to the income statement and talking about LIFO, last in, first out. Remember, we believe, or analysts believe, that LIFO would be a better measure of the true economic cost of producing your goods and services than FIFO would. Why? Because if you use LIFO in an inflationary world, then it means your cost of goods sold contains the most recent purchase prices and therefore is closer to replacement cost, if you like. So LIFO is better in the income statement. If we've got rising prices, LIFO of course will give us higher costs of goods sold. Well, why do we get higher costs of goods sold? Well, because compared to FIFO, our ending inventory of course is lower. So if we have a lower ending inventory, we've got higher costs of goods sold, beginning inventory plus purchases less ending inventory being our cost of goods sold. So higher costs of goods sold. Higher cost of goods sold, lower gross profit. Remember your gross profit, sales minus cost of goods sold. Higher cost of goods sold, lower gross profit. Lower operating profit. Operating profit margins, EBIT, often we use as a proxy for operating profit. And lower net profit. Okay, so our margins are all going to be negatively affected in this scenario. Now, liquidity. Liquidity, we talk about liquidity and solvency. And remember, liquidity is really your ability to meet your short-term liabilities as they fall due. Solvency is more worried about the capital structure and long-term liabilities. So when we turn to liquidity, often our prime driver is looking at the current ratio, comparing current assets to current liabilities. Now, remember, if we're looking at current assets, we prefer to look at FIFO, first in, first out. Because FIFO, of course, values the ending inventory at the most recent purchase prices, and therefore it's closer to its true replacement cost, and therefore its economic cost. So we prefer FIFO in the balance sheet, LIFO in the income statement as an analyst. Okay, now, if we've got increasing purchase prices, of course, FIFO is going to give you higher ending inventory. Okay, if it gives you higher ending inventory, your current assets are going to be higher, and therefore your current ratio will be higher. Current assets divided by current liabilities. Higher current assets, no impact on current liabilities whatsoever. And higher working capital, current assets minus current liabilities. Okay, with increasing prices, so inflationary prices, LIFO results in higher inventory turnover. So notice here's our inventory turnover, cost of goods sold over average inventory. Well, let's think about our cost of goods sold. Beginning inventory plus purchases less ending inventory. We, remember, said with LIFO, your ending inventory is smaller, so your cost of goods sold is higher. So we'll certainly expect cost of goods sold to be bigger. Under LIFO, of course, our ending inventory is lower. So average ending inventory, last year's ending inventory plus this year's ending inventory divided by 2, of course, is going to be smaller. Why are we using average inventory? Remember, we've got here a mixed ratio. When you've got part from the income statement, part from the balance sheet, and here cost of goods sold is from the income statement and average inventory is from the balance sheet, you should use average figures for the balance sheet items where possible. And it's because the income statement is dynamic and spans a period, and therefore it's better to use average balance sheet figures than simply year-end ones. Okay, now notice our cost of goods sold is higher, our inventory is lower, so of course overall this ratio is going to be higher. Higher inventory turnover. Now if we look at days of inventory on hand, roughly speaking this is the length of time between receiving raw materials and essentially selling your finished goods. So it's the raw material holding period, the production process period and the finished good holding period all combined together. We can calculate that as 365, number of days in a year, divided by inventory turnover. Now we've already said inventory turnover is going to be higher, so if inventory turnover is higher, 365 of course is unaffected, but inventory turnover is higher, so therefore we get lower days of inventory on hand. Okay, so now let's turn our attention to solvency based ratios, and we're looking at our leverage ratio here. Okay, so we're looking at two ratios, debt to assets and debt to equity. When we look at debt instruments, we either look at long-term debt or total debt. Most common in the exam would be to look at total debt, and remember that's all of your interest-bearing liabilities, long-term liabilities and also any interest-bearing current liabilities. Now, yes, with increasing prices, FIFO gives you a higher inventory value than LIFO. Both assets and equity are greater than for LIFO, resulting in lower leverage ratios. Yeah, or if you want to think about it, in the income statement, if we think about it, in our income statement, we've got a higher net income because you've got lower cost of goods sold. So you've got bigger profits under FIFO, bigger profits, higher net income, higher retained earnings. So if we think about debt to equity, the debt figure, of course, is completely unchanged. Equity is going to be higher because net income is higher in the income statement, and therefore, overall, the ratio is going to be lower. Debt to assets. Okay, let's turn our attention to debt to assets. Well, again, our debt figure is likely to be unaffected, but assets, of course, will be higher, giving you a lower debt to asset figure. Why will assets be higher under FIFO? Well, of course, your ending inventory is higher, but be aware, part of that is lost. Part of that benefit is lost by the additional tax that you pay. So when we were adjusting financial statements from LIFO to FIFO, we found under FIFO, ending inventory increased, but cash balances reduced due to the additional tax paid. Okay, but notice both our leverage ratios here are higher. Now, of course, we're also asked to be aware of the impact on our ratios. So inventory turnover, costs of goods sold over average inventory, of course, we've already talked about that one. Days of inventory on hand, 365 divided by inventory turnover. Gross profit margins, gross profit divided by sales. And of course, you'd find this final ratio on the face of a common size statement. Learning outcome, analyze and compare the financial statements of companies. So we're comparing between companies here and we're looking at the various conditions. So first of all, very low turnover, high days of inventory on hand. So maybe you've got very big balances of your ending inventory, for example. And you can see our interpretation, therefore, is slow moving or obsolete inventory. High turnover, so low days of inventory on hand, very quick period between receiving raw materials and selling finished goods, with low sales growth relative to the industry. Now, here, indication that we may be losing sales from insufficient inventory levels. In other words, we hold so little inventory, which would explain our very, very high inventory turnover and low days of inventory on hand, but that might mean that we're losing sales. In other words, customers are coming to us and we just simply don't have the goods to sell to them, sometimes referred to as a stock out situation. And that might indicate why we've got low sales growth relative to the industry. High turnover. Okay, so again we've got high turnover, so very rapid turnover of your inventory, low days of inventory on hand, a very quick period between receiving raw materials and selling finished goods. With sales growth at or above industry average, well, of course, here's the nirvana. We haven't got too much of our working capital tied up in inventory because we've got a very high turnover figure, low days of inventory on hand, but our sales growth, of course, is close to the industry average, indicating that we're not losing out on sales.